January 2026. Gold is trading at around $4,325 to $4,400 per ounce. Record after record. Since the beginning of 2024, the price has risen by more than 70%, from $2,600 to $4,400 in 2 years. But this is not speculation, not hedge funds, not retail investors. Central banks are buying gold like never before in history. Over 3 consecutive years, 2022, 2023, and 2024, net gold purchases by central banks exceeded 1,000 metric tons annually, with 1,044.6 metric tons added to global vaults in 2024 alone. More than 1,000 metric tons per year, 3 years in a row. This is a historical record. This trend continued steadily in 2025. Central banks purchased 634 metric tons by the third quarter, which, while slightly below the exceptional levels of the previous 3 years, remains significantly above historical averages. For comparison, from 2000 to 2010, central banks were selling gold, on average, minus 400 to 500 metric tons per year. From 2010 to 2020, they were buying, but modestly, 200 to 400 metric tons per year. Now it is more than 1,000 metric tons, 3 to 5 times more. Who is buying? Key players in this accumulation include Poland, which added 67.2 metric tons, Azerbaijan with 34.5 metric tons, Kazakhstan with 22.1 metric tons, China with 19 metric tons, and Turkey with 17.2 metric tons in the first half of 2025. China is the leader. The People's Bank of China has now reported more than 18 consecutive months of gold accumulation. Russia leads all countries with a staggering increase of 1,948 metric tons of gold since the year 2000, narrowly surpassing China's 1,885 metric tons. Together, these two powers account for more than half of all gold accumulated by central banks over this period. Russia and China together, 3,833 metric tons since the year 2000. More than half of all central bank purchases over 25 years. Other active buyers. Although Russia and China dominate in volume, several emerging economies have also been rapidly accumulating gold. India, plus 518 metric tons, increased its reserves in response to currency volatility and inflation concerns. Turkey, plus 501 metric tons, relied on gold amid economic turbulence and depreciation of the lira. Poland and Kazakhstan each added hundreds of metric tons as part of diversified reserve strategies. India, plus 518 metric tons since the year 2000. The Reserve Bank of India added approximately 600 kilograms between April and September 2025, bringing total gold reserves to 880 metric tons, and notably repatriated significant portions of its gold from abroad in 2024 for security reasons. India is bringing its gold home. It does not trust storage abroad. Poland, plus 448 metric tons, from nearly zero in the 2000-aughts to the top 20 holders. Turkey, plus 501 metric tons. The lira is collapsing. They are buying gold. Kazakhstan, hundreds of metric tons. A former Soviet republic accumulating reserves. Scale of the phenomenon. Globally, central banks now hold approximately 54,000 metric tons of gold, representing about 11% of total global foreign exchange reserves as of the third quarter of 2025. 54,000 metric tons. At a price of $4,400 per ounce, that is $7.6 trillion. 11% of all global foreign exchange reserves are in gold. In 2010, it was 8 to 9%. The share is rising. According to the International Monetary Fund, the share of gold in global reserves rose to approximately 18% in 2024, sharply increasing from mid-2010 levels, reflecting a structural reweighting toward tangible assets. 18% of reserves are the International Monetary Fund's figures, which are calculated differently and do not include certain assets. But the trend is clear. Gold is rising, the dollar is declining. As of January 2026, gold has already surpassed the euro as the second largest reserve asset in 2024, and is on the verge of surpassing United States Treasury securities in global reserve portfolios. Gold has overtaken the euro. Soon it may overtake treasuries. It would become the second reserve asset after the dollar. Why now? 3 reasons. Reason 1, sanctions are the new reality. When the United States and its allies froze Russia's foreign exchange reserves in 2022, policymakers across the developing world took note. If your reserves can be frozen at the push of a button, they are not really yours. Gold, however, is different. It has no counterparty risk. It cannot be printed, devalued, or blocked by sanctions. February 2022, Russia invades Ukraine. The West freezes more than $300 billion of Russian reserves. This was a shock to the entire world. Central banks believed their dollar and euro reserves were safe. It turned out they were not, a political decision, and $300 billion disappear. As a result, central banks increasingly view physical gold as a sanctions-resistant asset. This is also a calculated geopolitical strategy by countries such as China and Russia, often alongside other BRICS plus economies, to strengthen financial sovereignty and challenge the global dominance of the United States dollar, positioning gold as a neutral foundation for alternative payment and trade settlement systems. Gold cannot be frozen. It is physical. It is in your vault. No American court can press a button and erase it. Reason 2, de-dollarization. China, Russia, and the BRICS all want to reduce dependence on the dollar. Oil trade in yuan, settlements in national currencies, alternative payment systems such as CIPS and SPFS instead of SWIFT. But what backs the new system? The yuan, the ruble, gold. Neutral, belongs to no one, accepted by everyone. The dramatic increase in gold reserves by Russia and China is part of broader efforts to reduce reliance on the United States dollar. After facing Western sanctions, Russia accelerated its de-dollarization strategy, favoring gold to protect reserves from seizure or devaluation. Reason 3, inflation and distrust of fiat currencies. Persistent inflationary pressures and concerns about the long-term erosion of the purchasing power of fiat currencies further fuel the shift toward tangible assets. From 2020 to 2022, central banks printed trillions. Inflation surged. Trust in paper money declined. Gold is not printed. Its supply is limited. It is protection against inflation. Russia moved from being a seller to becoming the largest buyer. In the 2000s, Russia was selling gold. It needed dollars for imports. In 2006, there was a turning point. Russia began to buy. In the year 2000, Russia held 384 metric tons of gold. In the year 2024, Russia held 2,333 metric tons. That is an increase of 1,949 metric tons over 24 years, the largest buyer in the world. Why? Putin understood that dollars are a weapon against Russia. Sanctions in 2014, Crimea. Sanctions in 2022, Ukraine. Dollar reserves were frozen. Gold cannot be frozen. In a sharp break from half a century of central bank practice, Russia made headlines in 2024 by becoming the first country to publicly announce the explicit inclusion of silver in its state reserves. This strategic move implies the allocation of $535 million during the period from 2025 to 2027 to precious metals, including silver, platinum, and palladium. Russia is going further. Not only gold, silver, platinum, palladium, all precious metals go into reserves. The goal is full independence from the dollar and the Western financial system. China is accumulating quietly. China does not disclose the full volume of its gold holdings. Official data are understated. Officially, 2,300 metric tons at the end of 2024. In reality, analysts believe 5,000 to 10,000 or more metric tons. Why the difference? China buys covertly. It does not report to the International Monetary Fund. It buys through state-owned banks, sovereign wealth funds, private companies controlled by the state, and domestic production. China is the largest gold producer in the world, about 400 metric tons per year, and exports none of it. The Central Bank of China now reports more than 18 consecutive months of gold accumulation. 18 months in a row, buying every month, without pause. China's motives are clear. First, de-dollarization. China holds more than $800 billion in United States treasuries and wants less. Second, internationalization of the yuan. For the yuan to become a reserve currency, it needs backing. Gold is one option. Third, trade wars. The United States can freeze assets. Gold is safe. Fourth, status. Gold reserves equal financial power. The United States holds 8,133 metric tons. China wants to catch up. India and others followed similar logic. The Reserve Bank of India notably repatriated significant portions of its gold from abroad in 2024 for security reasons. India removed gold from the Bank of England. Why? They do not trust foreign storage. After the freezing of Russian assets, they think, what if it happens to us? Gold at home is safe. Gold in London is a risk. Poland increased its holdings from approximately 100 metric tons in 2019 to 448 metric tons in 2024. That is an increase of 348 metric tons in 5 years. Poland borders Russia. Ukraine is nearby. Risks are high. They want independence from the dollar and the euro. Turkey added 501 metric tons since the year 2000. The lira is collapsing. Inflation is 50 to 80%. Gold is protection. The West, by contrast, are sellers or passive holders. The United States holds 8,133 metric tons. It neither buys nor sells. Reserves have been frozen since the 1970s. Germany holds 3,350 metric tons. It does not buy. In the 2010s, it brought part of its gold back home from the United States and France due to mistrust. France and Italy hold gold, but do not buy. The United Kingdom sold half of its gold between 1999 and 2002, 395 metric tons at $275 per ounce. The current price is $4,400. They lost more than $125 billion in potential profit. Canada stands out. Canada, despite being a member of the Group of Eight, is the only major power that no longer holds any gold reserves at all. Canada sold all its gold. 0 metric tons. It holds only dollars and bonds. Switzerland and the Netherlands also sold most of their gold in the 2000s. Why did the West sell? From 1990 to 2010, they believed gold was a barbarous relic, outdated, while the dollar was king. Central Banking Quarterly in 1999 wrote that gold was dead and that central banks should sell it and buy yield-bearing assets. They sold at $250 to $400 per ounce. Now the price is $4,400. The price is soaring. Demand is creating a structural floor. Sustained demand from central banks has created a structural floor under gold prices, pushing them from about $2,000 per ounce at the beginning of 2024 to nearly $4,325 to $4,400 by January 2026. $2,000, then $2,800, then $4,400 plus in 2 years. Their purchases are deliberate, strategic, and largely insensitive to price, meaning that even when gold falls, central banks continue to buy. This persistent demand creates a structural price floor. Central banks are not speculators. They buy regardless of price. Price at $2,500, they buy. Price at $4,400, they buy. Price falls to $4,000, they buy even more. This creates a floor. The price cannot fall below a certain level because central banks absorb every dip. Forecasts. Bank of America says prices have the potential to reach $5,000 per ounce by the end of 2026. $5,000 by the end of 2026, another roughly 14% from the current $4,400. Other analysts expect $4,800 to $5,200 by the end of 2026. Is the gold standard coming back? A full gold standard? Like before 1971? No. Governments will not officially peg currencies to gold. It restricts money printing too much. But de facto, gold is returning as an anchor of reserves. The signs. Central banks hold more gold than United States Treasury securities in some countries. And for the first time since 1996, central banks hold more gold than United States Treasuries. Gold accounts for 18% of reserves and is rising. Dollars, euros, and yen make up 82% and are falling. BRICS are discussing a gold-backed trade unit, not a peg, but partial backing. Basel III banking rules from July 2025 classify gold as a Tier 1 asset, like cash. Banks can hold gold as capital. This is enormous. Previously, gold was considered a risk asset. Now it is equivalent to cash. Scenario, the gold NEO standard. From 2026 to 2030, central banks continue buying more than 1,000 metric tons per year. The share of gold in reserves rises to 20 to 25%. The price reaches $5,000 to $6,000. BRICS create a partially gold-backed settlement unit for trade. The West, the United States, and the European Union are forced to buy gold as well to avoid falling behind. The result? Gold becomes an anchor of the global financial system, not like 1900 to 1971 with fixed exchange rates, but as a top 1 or 2 reserve asset alongside the dollar. Currencies float, but are backed by gold plus foreign exchange reserves. Who wins? Russia, China, India, Turkey, Kazakhstan accumulated gold cheaply, roughly $300 to $1,500 per ounce. Now it is $4,400, gains of 200 to 1,400%. Gold-producing countries, Russia, China, Australia, the United States, Canada, mine it and hold it. Who loses? The United Kingdom sold 395 metric tons at $275, lost more than $125 billion in potential profit. Canada sold everything, 0 metric tons. If gold becomes a key reserve asset, Canada is out of the game. Switzerland and the Netherlands sold hundreds of metric tons in the 2000s. Investors in dollars and euros, if gold rises, fiat currencies weaken. What should ordinary people do? 95% of central banks expect further increases in global gold reserves. 95% of central banks plan to buy more. This is consensus for investors. Buy physical gold, coins, and bars. Central banks are buying. You can too. 5 to 10% of a portfolio in gold is protection against currency devaluation, inflation, and sanctions. Gold exchange traded funds, GLD and IAU, track the price of gold. Convenient, but this is paper gold, not physical. Gold mining stocks, Newmont, Barrick Gold. When gold rises, their shares usually rise faster due to leverage with higher risk. Do not hold all savings in one currency. Diversify across dollars, euros, yuan, gold, real estate, and equities. Watch BRICS. If they create a gold-backed currency, it will change everything. The dollar will lose part of its status. Gold will surge even higher. Final thought. The gold standard will not return in the form of 1900 to 1971, but gold is returning as a key reserve asset. According to the World Gold Council, central banks are expected to remain net buyers of gold in 2025 and beyond. As inflation concerns, geopolitical fragmentation, and the need for currency diversification persist, gold remains a neutral and durable store of value. Russia and China accumulated thousands of metric tons at $300 to $1,500 per ounce. Now it is $4,400. They won. The West sold hundreds of metric tons in the 1990 to 2010 period. Canada sold everything. They lost. Those who did not make it in time are too late. For countries, yes. If you are a central bank and did not accumulate over the last 20 years, you are late, buying at $4,400 instead of $300. For individuals, it is not too late yet. Gold is moving toward $5,000 to $6,000. Another roughly 14 to 36% upside. But the window is closing. When gold is $6,000 plus and BRICS create a gold-based currency, the train will have left. The question is not whether the gold standard will return. The question is whether you are ready for a world where gold rules again. Russia and China are ready. The West is not. Who's on the right side of history?